your next great investment. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. We got a lot on the docket this week. This is our weekly investing power hour episode where we talk all things financial markets. We do these live every Thursday at 5 p.m. Eastern Time. So if you want to get any questions in, feel free to hit us up on YouTube. Head on over at 5 p.m. Eastern Time and ask away in the live chat. We've got a SoFi short report from Muddy Waters, controversial one, popular name. There was a bit of selling in the stock. We've got the trade desk, not technically sued, but protested by one of its largest customers. We have absolutely insane revenue numbers out of the largest memory chip maker, I believe the largest, Micron, who reported earnings this week. And we've got plenty of other news as well. OpenAI potentially giving up to Google, some Uber partnerships, and plenty more. Brett, how are you today? Where do you want to start?
Well, I want to start by saying if anyone cannot join the live stream, they can always join the Substack chat and ask away. I always do a pre-show. I try to do at least 24 hours before, maybe on a Tuesday or a Wednesday morning as well. I usually toss out the same thing. Hey, what do we want to talk about this week? So if you can't make the live show and you have something you are dying for to retail investors to talk about, ask away.
Yeah,
But
usually I think we hit the big topics, but sometimes we might miss a thing or two. And if you have any specific companies you want us to look at or anything like that, the Substack chat is the place to do that because it gives us a little bit of time to actually prep and add some notes instead of just doing a live take. Do we want to talk SoFi short report?
let's do it. I didn't have time to read it, but it looks like you made quite a few notes here. Of course, Muddy Waters, pretty popular short seller. Well, unpopular in certain circles, but they've been around for a long time. They're not afraid of any controversy. What were they saying here, Ryan? And can I assume that I think we talked about it on the episode that came out this week where, new lenders, lending businesses, it's all about trust and were we vindicated by our hot takes that some people give us pushback for?
Yes. Well, vindicated by this report and some of the allegations per se, but obviously at the moment they remain allegations. So, I do want to maybe take a sec to there when we talk about short reports, they can be almost intimidating if you're a shareholder. And there are a lot of shareholders that just ignore them. There's a lot of shareholders that try to dismiss whatever they can, discredit the short seller. My general piece of advice, because I don't know if you've ever had a company that you've owned where there's been a major short report that was released on it, but my suggestion is to read it, take some time, don't make any decision the day of, wait for a response, and give it some thought, but wait to see what management says is usually my opinion. It can be very frightening, I think, as a shareholder. Have you ever had this happen to one of your companies?
Well, we've had one that we both own, Ryan, Remitly Global. And I actually forget who did it. Was it Spruce Point? Is that? It's very hard to remember all the investment fund names. It was a complicated slide deck. There were allegations of I actually forget what the allegations exactly were. The thing is, they ended up being right, even though what they said was going to happen with total deceleration of the business didn't happen. But when you read one of those, yes, it does always sound scary, and sometimes they're right, sometimes they're wrong. But I agree with you. Take a step back. You don't need to sell immediately. If you have a thesis on the company, well, just take it as another piece of information. And look, you try to digest it, figure out if they're right, and if you're worried that they're right, there's other fish in the sea.
Yeah, I wouldn't be too quick to discard short reports either, especially ones that are alleging fraud potentially, because some short reports are just based around we don't think the company's going to grow or whatever. They just are don't believe in the business. But if it's alleging fraud or aggressive accounting, which in the case of SoFi is what they are alleging here, and I'll talk about that, I do think it's important to actually look at some of these and try to get a response or some clarity from management. So let's talk about this. Here is the first paragraph. Muddy Waters says SoFi is a financial engineering treadmill, not a healthily growing origination business. SoFi shareholders are incessantly diluted so management can hit bonus targets through GE Capital style loan marks and Enron esque off balance sheet structures that disguise borrowings as revenue. Thoughts on the first sentence there, Brad?
Well, whenever you toss in GE or Enron, and yeah, I mean, I think that's just we know why they're using that term. We'll see if there's any validity to what they're doing, but I could see, the SoFi having GE style stuff. Enron, I have no idea what they're actually alleging here, but or alleging here. Yeah, we'll see. What are the specifics here? Let's actually get to what they think SoFi is
Sure.
doing that makes it a short.
So the focus really of the report was that they believe SoFi is engaging in fraudulent or at a minimum very aggressive accounting in order to hit bonus targets. So there were several different accusations in here that I think are worth talking about. I'll go maybe spend some time on the ones that I think really matter, and then some of the I'll hit on some of the smaller ones as well. So the first and probably the most pressing was an accusation that SoFi materially understates its net charge-off rate on personal loans. And personal loans are the largest percentage of their loan book now. It's been we talked about this I think 2 weeks ago or something like that. It's been a very quick expanding portfolio or of loans for them, and the crux of Muddy Waters' accusation here is that they say or they claim SoFi understates the net charge-off rate in two ways. One, uh, they use the 120-day delinquency rate, and they say that SoFi disposes of loans close to the 100-day charge-off threshold in order to get them off their books. And then they, too, apparently park defaulted loans in unconsolidated VIEs. That's sort of the Enron accusation part. The SoFi estimates that its net charge-off rate, or I should, Muddy Waters estimates that the true net charge-off rate for personal loans is closer to 6.1%, while SoFi states, as of last quarter, that their net charge-off rate is 2.8%. This is the reason this is important is because that net charge-off rate is used as one of the big inputs for the fair value assumptions of these loans. So when they originate new loans and they book the earnings, it can be basically them potentially misleading or booking earnings that aren't going to materialize. Any thoughts there, Brett? Real quick.
Yeah. That's a pretty sharp allegation. What is it? Over double the actual net charge-off rate that they're or the stated net charge-off rate if they're doing this. I mean, it makes sense how they can do this. That feels pretty logical. It's before they hit the threshold. I'm not sure exactly if that's totally nefarious, but if they're putting defaulted loans off balance sheet and they're not actually stating that they're there, I mean, yeah, that's clearly misleading accounting because your loans are worse than you're reporting to investors. That's pretty cut and dry if that's what's happening.
Here's a quote from the Muddy Waters report. It says, in one such transaction, SoFi sold $62.5 million of defaulted but not necessarily charged off loans to an entity called Altura Ventures LLC for $5 million. That's 8 cents on the dollar that it was selling those loans for. Now, and the other accusation here is that they're selling to these entities who are just reselling them, and that maybe there's some suspicious activities with these entities that they're selling to. The second big accusation here was that SoFi is using a manipulative financial modeling technique on their student loan portfolio. So, on their $12.9 billion student loan portfolio, which generates approximately $450 per year in day one fair value gains, and some of this gets complex into the bank accounting, but basically they're saying that they're recognizing these paper profits at origination before a single payment has been collected, which is apparently
That's
ultra
Enron,
aggressive.
baby.
Yeah, the and then I'll kind of rip through some of the other ones here, and then we can get some takes. Third big accusation. I'm not totally sure how this works because if you're reading this, my guess is that some of the SoFi shareholders were a little confused, honestly, and maybe didn't realize all the, I guess, secondary market activity that goes on with bank loans. So they are alleging that SoFi is seller financing sales of their whole loans to make it look like the fair value marks on their personal loans are valid. So basically, they are paying companies to buy them from them. They apparently received a letter from the SEC about this, and then in the last few days of a quarter, shrunk the outstanding balance, and in order to do that, borrowed $312 million they have not reported in their financials. This is, again, what Muddy Waters is saying. I'll fly through the rest of these here. The other allegation says SoFi's loan platform business is not a capital light toll booth generating fee income. It appears to be a wet funded forward flow transaction, a disguised form of borrowing whose loan proceeds SoFi books as fee income. They compared this to, again, the off balance sheet structure that Enron used. Two more here. Brett, I see you're about to chime in. So,
Well, I was gonna say I'm confused on what this last part is. The LPB thing, the loan platform business. So are they selling it to themselves? Is that what they're doing? What's
I
the allegation?
believe so, or selling it to entities where they've done seller financing or like suspicious entities. I think is the assumption
Okay,
here.
okay.
Um, let's go through some of these other ones. In 2025, SoFi capitalized approximately $194 million of marketing expenses instead of expensing it to hit adjusted EBITDA targets.
That's a red card right there. That's tough.
Yeah, and then here's the last one I'll talk about, and this it would be the most concerning for me if I was a SoFi shareholder. It says while SoFi's 8K filings state that Noto has not sold any SoFi stock, Noto and CFO Lapointe have extracted approximately $58.3 million through prepaid variable forward contracts, instruments that are economically equivalent to stock sales. The seller receives guaranteed cash today. The share transfers at maturity, or the shares transfer at maturity. In total, Muddy Waters estimates that SoFi's total adjusted EBITDA for 2025 was actually 103 million instead of the roughly 1.1 billion dollars that management states, so 90% reduction. And that's a compensation hurdle for them. So that
That's pretty rough. Yeah, that's pretty rough.
you can
If
see
it's
why
true,
this.
this is bad. The stock should go down 80%.
SoFi responded the next day. They had a press release. It was limited. They issued a three-paragraph response. The release did not specifically address any allegations. I'm not necessarily saying that's a bad thing because I think sometimes timing can be important with this, especially when someone's alleging fraud. You don't want it to just linger there for 5 days while you fix up responses. But they did avoid commenting on anything specific from the allegations. Here was the first paragraph of their response. The claims made in the Muddy Waters report demonstrate a fundamental lack of understanding of our financial statements and business. We intend to explore potential legal action against Muddy Waters for the factually inaccurate and misleading report that they shared about our business today. I'm going to give my quick thoughts here, and then we can get yours. My first thought is I would not really care too much about this, honestly, if I were a SoFi shareholder, if Noto truly had never sold a share. And because if he had a huge chunk of insider ownership here and he hadn't sold a share, then there'd be no incentive to deceive or manipulate the number, right? But the variable forward contracts show that he basically has booked share sales, or at least whenever he says, or the company says he's never sold a share, you know it is at a minimum disingenuous, which I would find frustrating. The second thing here, this is the difficulty of a lending operation. I think this is why SoFi shareholders were kind of stunned, and most shareholders just basically said, Muddy Waters was wrong about these companies in the past. Discredit them. Don't listen to this. This is nonsense. Because the issue is, we don't know. Minority shareholders here do not know what the true default rate is in the loan book for personal loans. It's a black box, which is part of the issue with a fast-growing lending business. And then the third thing, and this is maybe the biggest, this is the issue of having adjusted EBITDA targets as executive compensation hurdles because there's no limit to how much can be adjusted or the things that they can do to make that number say what they want.
That's
Any
fair.
thoughts from you?
Yeah, those are all fair. I think with the loan book stuff being a black box, I think maybe more so it's in a almost no one wants to put in 20 hours of work to analyze this and spend you know what I'm saying? Where yeah, like someone like Buffett can go through during the financial crisis and look at what were they, Lehman Brothers, Goldman Sachs, I guess they ended up investing in, but he was given an offer like, hey, take a look at this business. What do you think? Could you help us out here? Do you see any potential value if you could come in as a savior? And he analyzed it, but there's very few people out there that have the skill to analyze a financial like this. I don't think I really do. And then, do you want to put in the time? No. This is another example for me. If I'm going to invest in a financials company, the one that we have a long history with is probably just Nelnet. I don't think anyone else in our respective portfolios are true banking entities, and that for me is just solely based on trust. You have to be just trusting in them as operators, and when you're someone like SoFi that has new management, new relatively of the last 5 years or so, and getting into new lines of businesses that are growing quickly, it's gonna add a layer of potential risk. And even if none of these what they did here, yeah, you know, that connection to actually selling stock when you stated you weren't, you know, synthetically, and then having those adjusted EBITDA targets, yeah, that's clear cut and dry unethical behavior by a management team. But maybe some of the things that they did, it wasn't necessarily like on purpose, where you know maybe Muddy Waters is alleging this type of stuff, but it's part of the business that makes it tough, and maybe it looks worse. You know, they're an upstart, you know, for lack of better, no pun intended there, financials company, and maybe they're just making a bunch of mistakes. Either way, if they're
Could be.
actually like either if this stuff is true, either way, the business is in much worse shape than people thought.
I
We
do
have
want
some
to.
comments, or go
I
ahead.
just want to say we probably have some SoFi shareholders that listen to this podcast regularly. Again, I would wait. Also, it is worth noting Anthony Noto bought shares that day that this came out.
Okay,
I don't know if that's optics or what
it's
that really means.
optics.
The but I've been. I mean, I think we did a deep dive on SoFi a year ago, or I did, and I was fairly optimistic about the business. I'm on the deposit side. This is a really fast growing fintech. Like it's a slick consumer app that's done a really good job growing customers and deposits. It's the lending side for me that has kept me away and has been the only hesitation for me from being a shareholder is I just have no idea what the true net charge off rate is for personal loans. Without knowing the industry super well, 2.8% on personal loans seems low.
That's fair. It depends what you're underwriting. I mean, American Express is 2%, but they're the top end of the market. It,
Right.
for them specifically, SoFi, it's just the fact that you have a unsecured personal lending business growing really quickly. We don't know exactly how that's going to turn out. It could easily just get super ugly within a year, and maybe that's what's happened. We have some comments here that says, "I will be honest, I don't know a single person that uses SoFi." Well, yeah, there could potentially be allegations against how active one of their active users are. Yeah, I don't know. I
Technically,
think
just members is the definition. So,
yeah, you remember. Have you signed up for an account? Yeah, that I would look into the definition of that. Maybe it's looser than people think. That's something I would definitely look into if I was considering investing. We have a comment here from Tyler saying banks can almost grow as fast as they want, but good bank operators are extremely disciplined and often limit growth to a slow pace. These SoFi accusations seem crazy. Maybe there's some smoke, but what are regulators doing if SoFi can get away with all this? A fast growing bank should be where regulators focus. I think that's true to a point, but regulators, what are you going to do? I, th- there's so many loans out there. I guess, I don't know, you can't expect them to inspect everything. It's
no.
more of a audit issue, correct? From the
Deloitte,
SEC.
I believe. Oh, Yeah, and some of the stuff would be apologies if you hear the dog barking in the background, would be on the auditor's hand, which I believe in this case was Deloitte. So, it, but even they can be sort of
Oh,
sorry about
there's the
that.
dog. Why don't I keep? I'll keep talking here if you want to get muted there. Yeah, I know I agree. I agree with you there. It's not regulators aren't going to pick up anything. And if you look at the history, complaining about the SEC, there's that. I don't know if it's famous, but it's always memorable to me. The scene in the comedy, the other guys, where they say, "What do you actually do with the SEC? There's all these frauds out there that you never catch, and you only catch them in hindsight." I think you should expect that to continue, and that's why you have to stay vigilant, respect the what do you call them, the forensic accountants out there. You have to respect the short report people such as Muddy Waters that I believe are doing it. Yeah, they want to make money, obviously, but they're not doing it disingenuously. There's some out there, just like people in the long, uh, the people that are just pump stocks all the time. There's people like that on the short side, but you have to read that, listen to them, think if you agree, and a lot of the times when there's smoke, there can be fire. Um, yeah, I wouldn't touch this thing. That's all I'm saying. There's got to be better opportunities out there. Like,
Yeah.
it's just tough for individual investors to buy these type of things because if these loans go sour, given how levered these businesses are, if you play around with accounting at all, you can get burned really, really quickly.
Okay, you want to take some questions here from the chat before we move on?
Sure. Let's see. We had someone say, how do you think the market would react to a massive acceleration in revenue growth at the hyperscalers, AWS above 25%, GCP, Google Cloud above 50%, Azure above 40%? I think it's almost priced in. I want to be honest. For 2026.
Yeah.
They're increasing their capex at such a high rate, and they're stating that there's a huge amount of demand that's not catching up with supply yet. So there's going to be this huge boom, and I honestly think it's priced in.
Yeah, it certainly feels expected given the capex guide and that they are saying that they're for as fast as they're growing capex, they're booking it as well. So it, I think it's pretty likely. We'll see on how would they'd react. My concern is that like if cloud accelerates again, we're just going to see more commentary about capex growth from the management teams, and it's like push and pull because analysts seem to not like the capex guides, which don't blame them, and obviously you like the cloud acceleration.
Okay, we have someone asking here about grocery outlet. Recent 10K said that they do a 50-50 gross revenue share with store operators and how this compares good or bad to others. I remember we covered them a while back. I haven't kept up with them, but feels like good incentive alignment. I wouldn't read into it as necessarily good or bad. Whereas, are the hurdles good? Does it lead to good performance all around? I mean, you can have a 50-50 revenue share line, but you have to think, well, does it actually incentivize everyone to do well? And is it going to leave a little bit for shareholders at the end of the day?
Yeah, we've had two people now comment. Any updated thoughts on Kelly Partners Group? We actually talked about them last week on the Power Hour, so if you want to check that out, we touched on some of the AI risk, maybe, and then the opportunity and the revised valuation as well. By the way, if you're heading to Berkshire this year or Omaha for the annual hiatus, they have their own event. Apparently, Kelly Partners Group is doing their own event at Berkshire. You might be able to get more context there.
All right, yeah. So I'm sure the CEO will be there. That's one that, yeah, I follow somewhat closely, but it's not. I can't say I'm an expert on it at all yet. We have another, and this is a tease from someone that is going to be on next week. Have you guys heard of this G dot merger arb? GDOT seems mispriced to me. Total book value around 0.5 times. Ryan, have you heard of this? I'm assuming no, but maybe it's a
I have
small cap
not.
of the week we can look into. I appreciate the idea generation, and yeah, there's always something to do, even if things look crazy out there and oil is going to $150 a barrel.
I will say I've gotten away from the merger arb game a bit. I can't remember the last time
What do you
I.
mean, Activision Blizzard? We did it. We did all right.
That did not. Well, whatever. It worked, I guess. What was the other one that ended up working out? It was like
Oh,
the semiconductor company, I think.
IDN, I think they're a memory player.
No, 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 no.
No.
IDN was that small cap IntelliCheck. I can't remember.
Oh,
It was like a Korean company or something, but it was like the merger spread was massive.
it was NAND memory chips. I'm sure their stock is soaring at the moment. Yeah, I can't remember. I can't remember if it even worked or not. I think it actually didn't go through, but they maybe have been better for it. Okay, what do we want to talk about now? Nvidia, a lot of announcements, a lot of press releases, $1 trillion in revenue, allegedly. Uh, the high tide earnings, Uber and AV partnerships. It's kind of the same old stuff every week at this point. It's just so many press releases. I can't get over it.
Let's go. Maybe some of these Uber partnerships. I want to switch to a high note here and some positive developments.
Do you think this is positive for Uber?
Maybe, maybe.
Yeah, we can debate that. That's I guess my question at the end of the day here. I'm not sure what I think. So they're announcing a lot of partnerships within the autonomous vehicle and self-driving taxi space. They just announced, I think, a couple days ago, or maybe even yesterday, $1.25 billion investment into Rivian to accelerate their AV goals, not EV, not electric vehicles, autonomous vehicle goals. So both companies are going to work to get Rivian, I guess, robo taxis onto Uber sometime by 2028. I'm sure Uber got pretty good terms on this deal because Rivian is struggling quite mightily as a company. They need funding, they need cash injections. Volkswagen's been doing that for them as well, and they're hopefully getting that DOE loan. But besides that, they have an expanded partnership with Nvidia. Nvidia apparently is going to have robo taxis on the market by 2028, 2027. But at least Uber is going to be powering something with Nvidia's software for autonomous vehicles. Uh, I don't know exactly what that is, but we'll see.
Yeah, not sure
Nvidia
I
seems to,
follow that one.
yeah, they I guess have software. I've never understood that part of the business, but there's a company called Wave, and they are partnering with Nissan and having Nissan Leafs, who autonomously driven on the Uber platform in Japan. Zoox is joining Uber, the Amazon startup, within I think San Francisco and Las Vegas. And Uber itself launched Uber Autonomous Solutions, which allows autonomous vehicles and autonomous vehicle companies to easily onboard to ride sharing. So getting onto the Uber platform. Uh, It's a lot of announcements. Clearly, it's hard to keep up with. The company is pretty press release heavy. What do you think? Is this coming from a position of strength or a position of weakness for Uber? Because you have all these small players they're partnering with, but then you have the Teslas and Waymos out there that many people are scared of. I'm more scared of Waymo, but there's those big two players that are trying to compete without Uber, at least for most of the time.
I'd argue that it's a positive development, but it does feel like they know what the narrative is around their stock and that the big risk being Waymo. So they're trying to diversify their partnerships as much as they can, even if it's maybe more noise than news at the moment. Like it might just be press releases for the time being, but I mean, in theory, the more autonomous vehicles or autonomous vehicle companies that are on their platform, the better. I think that's like that makes them the platform, the powerful platform, as opposed to being beholden to Waymo. But it does kind of seem like maybe they're doing all this to for optics, so that it doesn't feel like they are beholden to Waymo.
I think it's coming from a position of weakness. I'm gonna be honest. They know. They just know. They see Waymo's growth rate. I'm still on this.
I don't buy it. I don't buy it.
But why do they need to invest $1 billion in Rivian then? Why? It's
Yeah,
going like
I don't know if
Rivian
that
is
makes sense,
probably
but
Rivian stock is probably going to zero. Like, have you seen their business?
no, I haven't kept up with Rivian. But like, if we're going around again on this Waymo versus Uber debate, like I think I stand in Waymo's or Uber's corner here. It feels like Waymo needs Uber more than Uber needs Waymo at the moment.
Nah. I just disagree. We don't have to talk. We have other things to talk about. We've talked about this many times. But when, for example, Apple Premiere is the premier smartphone platform, you could call it, right? Pretty much for all of existence and up till today, almost every company has to go to Apple, kiss the ring, they'll do what they do. Apple doesn't need to beg companies to come to them because they have all the power. Now, that's flipped a little bit in recent years because of this AI stuff where now they're paying Gemini slash Alphabet, where before Apple was receiving a huge amount of money from Google search. But usually Apple just goes, no, sorry, we're not going to approve your app. Sorry, it took us a month to approve it. Or sorry, you're going to pay 30%. Uber has to go out and try to go to all these companies. I don't think they're coming from a position of strength where they don't hold all the power in the industry.
I mean, you don't think these AV companies are wanting to partner with Uber?
Oh, I think they do, but I think these AV companies are, I mean, it's like DuckDuckGo versus Google. It's nothing. Like these companies have nothing on the road. There isn't anything. Cruise has nothing. Zoox has barely anything. Waymo dominates.
But are they worse? But is Uber worse off for having these deals in place in the event that these vehicles or these companies do start to have vehicles on the road? Like it feels like they've got no choice but to partner with these companies.
Yeah, but if Uber had all the power, the companies would just come to them. They wouldn't need to pay $1 billion to have them join. That's what I'm saying.
Yeah.
Apple doesn't pay Spotify. Hey, you got to use the Apple platform.
No, but I don't know. I still think there's the supply issue with Waymo that we talked about with the oscillating demand, but and Uber solves that. But let's shift gears because we have had that conversation before, and I should say we did a full Uber deep dive with Aria a while back. That I would I think most of that conversation was about the Uber versus Waymo debate. So
Yes, more detailed discussion there. What about this trade desk allegations? This was pretty surprising.
the trade desk, you
The
mean?
trade desk, just like
Which
the
is
Ohio State University.
it
Yeah,
is still one of the most frustrating names in public markets for me, actually,
I own one
because
of these. The real brokerage. We're going to the real brokerage. Yeah, it's
yeah,
great guys.
it's infuriating. Anyway, so Publicis Group, which is one of the largest advertising companies in the world, commissioned a private audit of the trade desk and allegedly found multiple violations of their service agreement. Publicis Group accounts for more than 10% of the trade desk's gross billings. Allegations include that the trade desk applied its demand side platform fees to additional charges not permitted by the contract, that clients were automatically opted into tools and billed for them without consent, and Publicis says that the trade desk failed to provide data needed to verify that media costs were invoiced without hidden markups. The big issue here, aside from the complaints, uh, is that Publicis delisted the trade desk and advised its global clients to stop using the platform. That is way more harmful than just a pure lawsuit. And this to me is way worse than any short report or anything like that. You've now just, A, lost potentially 10% of your revenue, but also lost credibility across the board and probably across the industry. The trade desk is now down 83% from all time highs. Is there any world in which you end up
No,
buying this?
nope. I'm gonna answer before you finish the question. Trade desk is just a tough market. The last 5-6 years we've been pitched many times on this show by outside guests, reading reports we've talked about in Power Hours or maybe deep dives. You have the trade desk, Pubmatic, wasn't there Magnite, all these other players. I mean, Amazon's in the game now, but they have it more of as a holistic solution for Prime Video and Amazon sponsored listings. It kind of makes sense. Eh, no, no, this is a tough field. And look at their PE. I've written a bunch of Motley Fool articles on them. I'm sure if we look at Fiscal.ai right now, the trade desk is trading at a PE of, all right, load for me, 26. This isn't right. Like it's not a PE of 10.
Yeah, are they, I mean, under earning, or is that like what you think steady
EV to
state
gross profit is
margins?
4.5. So to be fair, maybe they're under earning, but they're in a very competitive spot. I mean, I think what the AI overview that Fiscal.ai has makes sense. It says there's a structural disadvantage. Well, it says that they're competing against Google, Meta, and Amazon. I wouldn't want to compete against Google and Meta in advertisements. We've said this many times. And Amazon is obviously a big player as well.
There was also a lawsuit against them this week that they drastically overstated what their new Kokai platform, Kokai is the name of it, was capable of, and I guess underdelivered for partners. Anyways, yeah,
Tough week for some growth stocks, man. I'm glad I'm not in any of these things. October, November, December was tough for my portfolio. I think you as well. We have some overlap, but man, yeah, I feel bad for anyone that holds these trade desks in SoFi.
you know what we haven't talked about on this show yet is the decline of Bumble.
I know, and the stock they had a somewhat. I don't know. The stock went up 50% on I don't know. It's
It's like a
something.
cigar butt. It's trading like a
Yeah.
cigar butt, and it might deserve to. Users have just like I think they dropped 20% or something like that year over year. It's
Mm.
maybe pull it. I'll pull it up on Fiscal. This is our
Our live look.
weekly plug for Fiscal AI
What?
here.
Yeah. Okay. I'll give the ad while you pull up the numbers here. Fiscal AI is Fiscal.ai is the best, I'd say, terminal that you can use within your browser for all sorts of financial tools. And they put out stuff all the time. Ryan is, helping marketing and getting the word out. But one product feature that I've been requesting for the last, I'd say, 2 years has finally made it through, and it's annotating conference calls and maybe other stuff. Maybe not just transcripts, but at least transcripts where you can highlight or you can tag something, and you can have your own notes being taken within the app or the web browser. So it's just fantastic. Where okay, instead of having my own Google Doc or written notes on a yellow notepad, I can actually put it within that specific point, and I can come back to it for that company. It just provides a ton of value. You can use our link fiscal.ai/chitchat, get 15% off any paid plan. You've heard us talk about them plenty. All right, Ryan, that's a long enough ad. What's Bumble looking like here?
Here's your Bumble app paying users year over year change. They were growing 35% 3 years ago. Today they are declining 22%. Here's the actual uh, specific app numbers. They were officially, for the first time ever, eclipsed by Hinge in total revenue
Wow,
this quarter.
that is interesting.
Would you ever
It's
get back into the dating apps? Not as a user,
investing
as an investor.
as an investor, probably not. All of these businesses, and you look at something like Hinge that is growing within Match Group, doing fairly well financially. It's growing. I mean, it's not growing explosively on a revenue basis, but it seems to me, and maybe this is just reading stuff on Twitter and being 29 years old, but it seems like everyone just uses that app, and eventually they're not. Like Tinder and Bumble are pretty much dying. That's purely anecdotal. Um, so yeah, I I don't want to lose any more money owning these investments. I'll make my money somewhere else.
Yeah,
But
I think I'm with you. It can't get cheap enough for me to get interested. It is.
yeah, well, maybe with Match Group's buyback, maybe there's a price. Like it's significantly lower than here, but
Here's Hinge versus Bumble.
ooh,
Um,
that's a pretty chart. Wow.
but here's the issue: is I used to love these businesses because I thought there was a wonderful network effect. Like right, like the more users you have on there, the more people want to be on there because there's more potential dates.
That's fair. No, I mean that is a benefit to
Right,
scale. There is a benefit to scale.
but we've now seen two apps in a row deteriorate in their network effect and get replaced by a new app again. So Tinder, Bumble are both seeding users to Hinge. Is this going to happen to Hinge again? Like, I just, I don't know. The staying power. I've been underwhelmed by the staying power of dating apps.
Well, I guess yeah. The point is, uh, if you have like there is value obviously, and if uh Someone said here that the podcast stopped recording sound. Uh-oh. That's not good. You can hear me, right, Ryan? Video still works.
Yes, I can.
I can hear you.
All right,
That's
this might
not
make
that's
for
not good.
rough
Maybe the
audio.
live isn't working. If not, unfortunately, it'll work on the recording. But I don't know exactly how to change that because Ryan and I's looks totally normal. For anyone, okay, it's back. Yeah, Bugs by Riverside. We pay them their annual fee, and it seems they come up with a new bug for their software every month. All right, let's get back to what we were actually talking about with the dating apps because we have a lot of topics at hand today. I think the last thing I'll say is you can build a network effect within a dating app within, let's say, a good one, um, a good city, New York City. That's kind of a premier one, large city, wealthier people, a lot of people willing to spend. You can build a network effect there by getting a lot of people to join your app, but I think it's easy to if you have one, it doesn't mean you can't start 5 others and get people to start joining those. So that's what makes it hyper competitive. You don't have a network effect that really builds a sustainable moat. It it kind of is it's just a little bit flimsy. And we learned that
Yeah.
the hard way by losing a little bit of money in that.
Okay, I want to briefly touch on Micron's earnings because
It's a chart. Yeah. That's a chart right here.
this was outrageous. Maybe you can share this chart. Pull it up.
Yep.
Fiscal AI again. Shout out. And this was so Micron reported earnings yesterday, as of this recording, maybe 2 days after this will be released on the podcast players. And I thought this was a mistake when I first pulled it up. And by the way, shout out to Fiscal AI. The data's up in usually within minutes of an earnings report. The they reported so they have gone through, I guess, maybe 10 years of cycles where it was at the max $9 million or $9 billion in revenue per quarter, and then last 2 quarters ago they printed 11 billion in revenue, then 14 billion, and then out of nowhere, 24 billion in revenue last quarter. Their revenue growth accelerated. So revenue growth last quarter was 57%. This quarter revenue grew by 196%. Now I'm not very. I'm pretty sure Micron's like an eight bagger over the last like 3 years or something astounding. The I'm not really interested in Micron as an investor just because it's not really my expertise and it seems to be a cyclical industry historically, actually one of the most cyclical industries. And we talked about that on the recent Capital Cycles episode, where memory chips have historically been one of the most cyclical industries, and you get huge investments from the big producers when things are going well because they invest into the success and it makes sense. Here's a quote from the press release. Brett, get ready for this. In the AI era, memory has become a strategic asset for our customers, and we are investing in our global manufacturing footprint to support their growing demand. Reflecting confidence in the sustained strength of our business, our board has approved a 30% increase in our quarterly dividend. This is the this is the catch, right? It's like, and here's the thing: Micron reported 196% revenue growth. The stock dropped 4% today. This, and I
Well,
think,
and people knew what was
sure,
going
yeah,
to
yeah,
happen.
yeah, it was kind of baked in. But when you see 196% revenue growth and outrageous demand for your chips, what are you going to not invest in expanding
Yeah,
your
it's tough.
footprint?
Yeah, you
Like,
can't
how do you?
resist.
You
You can't
have to.
resist. Samsung just announced, I believe I read this in the Wall Street Journal this morning, uh, $70 billion in capital investment commitments. So that's another competitor. Yeah, it's just an industry where if all you have is scale and there's multiple competitors, there's going to be someone that's going to want to invest, get more supply online, take advantage of the high prices, and then the high prices eventually solves itself because supply matches demand. It's how it always goes. And unless you're someone like TSMC with processing advantage, meaning that no one's able to compete with them on advanced chips, yeah, you're in a riskier position. And yeah, I wouldn't be interested in Micron, but I am interested and glad that they're investing in more supply because it really hurts Nintendo. It all comes back to Nintendo for me.
Yeah, the one caveat here I'll say is they are investing heavily to increase their manufacturing footprint, but they also approved a 30% increase in their dividend. So it's not like they're reinvesting all their money back into expanding capacity, but yeah, it does feel like classic capital cycle at play here. Do we want to talk Nvidia's maybe Nvidia and coupon real quick?
Sure, yeah, and our portfolios are getting in on the AI hype train, Ryan. Let's see what you think about this quote from this press release. Coupang, a US based technology leader, they always love to say that, announced at the NVIDIA AI conference and expo today that its collaboration with NVIDIA has helped Coupang create a quote AI factory, which is accelerating new innovations across the company's e commerce, logistics, and delivery services. And, just trying to just pump the stock. That's it. Like, who cares?
It,
Show me
I
a cloud.
already
Just show me your
assumed
own cloud. Like, I don't know. Just
I
rolling
already
my eyes.
assumed that they were having very technologically advanced factories, whether you call it an AI factory or not. My assumption here was that they have uh, great fulfillment capabilities. So this means pretty much nothing to me. It did surprise me that apparently they have a fulfillment center in California. I saw you
Oh
tweet
yeah, I
that.
saw that. I think it's for getting, and they bragged about this because they're trying to just really push the idea that they're a United States business. It's for getting product from the U.S. to Korea and I guess Taiwan. So you have brands. They try to go for the mid-sized brands. I think what did I see? It's like not mom and pop, but maybe a small to mid-sized business within consumer packaged goods or something like those pomegranate seeds and pomegranate juice. And then there was like some beauty and I believe some one of the Kardashians. I don't know. They were did a press release on that about bringing their products over there. That makes a lot of sense to me. You sell into Coupang's fulfillment center. You don't worry about anything. They put it on the Coupang platform. They get it over to Korea. They sell it to people. They give that brand their cut. That feels like a good business to me. You don't have to get it over to Korea. Like, it makes sense.
Yeah,
They're
that
not
makes sense.
competing with Amazon anytime soon.
Hmm.
I don't think.
Okay. Well, speaking of, did you see Amazon launched 1 hour shipping in some major U.S. cities?
I did. And what surprised me, and I think is something that shows that Bezos is not there anymore running the show. And I did hear more about this Blue Origin Amazon thing. Apparently, it's bad. Blue Origin's stealing a lot of talent, which is strange. I don't understand this, Bezos. It's your own. You're both. It's both your companies.
He still
But
owns a lot of stock.
I know, but maybe he just doesn't care. The what I saw here is that there's an extra fee to get 1 hour delivery on certain items, and I think Bezos would have said, "Screw it, it's going under the Prime bundle." What do you think?
Yeah, I agree. I think yeah, absolutely. It, if you can get 1 hour shipping in the included in Prime, that's a huge upsell. That's
You
pricing
just
power
don't
in
make
Prime.
everything. Just don't make everything uh, 1 hour.
Well,
Stuff
here's
that
the
people might need
difficulty,
within an hour.
Brett. How are you going to? You can't have any more loss leaders if you're spending $200 billion on AI data centers.
I,
No more. There's no more room
uh,
for loss leaders. Everything has
I
to be
know.
profitable now, other than data centers.
Ads will make up for it. Yeah,
Honestly, it probably won't.
it's interesting that they're getting closer to the rapid deliveries of Uber Eats, DoorDash, Instacarts. You can get grocery delivery pretty quickly now. I don't think any you have to have do a large enough order, but I don't think it comes with an extra fee in in
On what?
major cities in the United States. You could probably try it.
On
Someone in
Amazon?
Austin, yeah, Amazon. It's called Amazon Grocery. I actually tried it once to just test it out, investor style, and it was quick and pretty cheap. Like it wasn't even. It was
Wasn't
significantly
marked up.
cheaper. Not too much marked up. No, but
Okay, I do want to
yeah.
talk about this. OpenAI this week. Here's a quote. ChatGPT maker OpenAI's top executives are finalizing plans for a major strategy shift to refocus the company around coding and business users. Looks like they were trying to go after Claude's market. Does this does it feel like they're giving up to Google in any way, or they're just trying to chase Claude?
Whew, that's $1 trillion question. I think for one, the Anthropic guy, Dario, don't know how to say his last name, is just popping open the cigar and saying, you know, I beat you, Altman. He worked for Altman back in the day, so it is a pretty big rivalry. They wouldn't even hold hands at some India AI summit where everyone stands really strongly together and says we're partnering for AI, and then they wouldn't hold hands. They're supposed to hold hands, in a group photo. They wouldn't do it. So they do not like each other. And I think OpenAI is realizing that Anthropic was smart to go after enterprise. It's much more lucrative, and there's not going to be that much monetization. We've brought up the stats on this show before of what the amount of people that spend on uh, chatbot subscriptions is quite low. Even though I pay for Gemini Pro, and I'm pretty much, I'd say, a skeptic on this investment narrative. Like, not very many people are going to be using it at all. The fact that there's a billion people using OpenAI and most of them aren't paying anything, I think is an extremely flawed business model given your compute costs. So they need to find a way to get profitable. This is maybe a way to do that. It seems like they were able to pretty much catch up pretty quick with Anthropic, and they seem to be doing okay within the whatever it is, the enterprise agent market. But I, that's a good point. I'm not maybe giving up to Google is a little strong, but it shows that I think Alphabet, for better or worse, can be a bit more comfortable with using Gemini as a loss leader. Where OpenAI, they got to get profitable quick, given how bad their income statement is.
What do you think about this? OpenAI equals Yahoo.
Maybe. I think OpenAI equals I don't even PT Barnum times 1,000. Like this guy is just he's something.
So here's okay. It feels like OpenAI, ChatGPT generally has kind of lost its, I don't know, aura. I hate that word, but aura, I guess, in markets. Like, feels like it kind of has, it doesn't have the same like thrill to it. Like when people talk about Claude, when people talk about Anthropic, when they talk about Gemini, or anything Google's doing with AI, there seems to be a ton of excitement. And maybe I'm underestimating how many people use or how many businesses use OpenAI under the hood, like as an engine for any LLM stuff they're doing. But
Nah, it's majority. Claude has majority market share now.
I would be I'd be concerned that the consumers are more flexible than people think. And even if they use ChatGPT all the time, I don't think it's that hard for them to switch to Gemini. And Google still owns the most valuable real estate on the internet, which is their own search bar on Google Chrome. Just tab, enter, you're on Gemini. Like, I think it's really hard to compete with that. They
Yeah.
still have the largest market share, credit to them, but it feels like, I don't know, I kind of like the potential Yahoo analogy of 25 years ago.
Yeah, I think it definitely work. The I'm just what I'm very curious about is whether the IPOs go out for both Anthropic and OpenAI later this year.
I hope they do.
It, yeah, well, I want to see those S1s. The If you asked me 2 years ago in regards to AI, I would have said that Alphabet was very undervalued. We talked about that all the time. And they've shown their ability to regain market share. We'll see if they can push back. I think they're like 20% maybe on consumer now. We'll see if they can get even more. But I think it's extremely just uncertain what's going to happen because I think OpenAI still has a lot of use among consumers. Cloud is growing extremely quickly, but who knows what the potential growth is within enterprise. Like it's growing extremely rapidly now, but whatever the ROI is, we'll see. And I still think, well, maybe I've changed my mind a little bit on. I think Gemini. I just it doesn't work as well as it should. Like I give it a Google
Gemini?
Maps. I give it a Google Maps. This is the same company. I give it a Google Maps link and I say, tell me what this place sells or something. Can I buy X thing here? And it goes, oh, this is X and X store in a city 1,000 miles away. And I go, no, look at the link I sent you. I like yelled at it once. I go, no, that's wrong. Like, look at the link. How is Gemini not fully connected with Google Maps? Is what I'm saying.
Yeah, I don't know.
I think if
Hey,
they didn't
low
have the
hanging
balance
fruit.
sheet, if they didn't have the balance sheet, they would have that connection. Now they can just act a little more lazily and not get
Yeah.
everything pitch perfect.
Okay. Do we want to talk about your bubble watch here? We got 5 minutes left here.
Well,
The
yeah, and I also
boldest
want to talk
take.
about. Yeah, did you see this? Did you see this? Did you
I
click on
just
the
saw it
link?
in your notes. Yeah.
Well, this is Barron's, and I found this on. I'm actually on Blue Sky now. Yeah, it's boring over there, but Twitter. I don't know. Twitter's getting worse, so
Yeah, it is.
it's back up. I like Substack more, but
Substack
you
chat.
get it. Substack chat's better. I know. I try to spend more time there, but here's what Barron says: Moody's warns of recession risk if oil prices stay elevated. First, I mean, just fantastic analysis. That's what you pay them for. Here's what they said: they put the probability of a U.S. recession at 49%, even before disconcerting events in the Middle East. I mean, bravo. What a bold take. 49%. I'm on a 50%. I'm coin flip only.
What a
This
what
is
that's like that is a they just said basically nothing. With
yeah.
all those words, they said nothing. It's like there's always a 49% chance of a recession.
Oh, I know. It just makes my head hurt. And then every one of the replies just puts it into some like political thing and like, well, I blame this person on. It's like
Yeah, no. The
politicians don't have the much of an impact
yeah,
on that.
social media is it's well, I'm only on really X or Twitter, and it's just
Yeah,
such a
it's getting
it's a
worse.
terrible experience. Like, what
It's
happened to
getting
FinTwit? I just need that back.
no. It's gonna send you promiscuous photos that you don't want. Just no, I don't want to see this. I want to see investing stuff. No,
Yeah.
how about this? Okay, yeah, thanks AI or thanks the algorithm. But why don't we talk about Nvidia's projections? Huh? We
Nvidia
missed this. Yeah,
at a conference this week, their
their
conference.
conference, their
Yeah.
conference, right?
What is it? GT something GTC? I
It's
don't
like their product annual product conference. Yeah.
know. Actually, a couple friends of the show were there, asked questions. Jose
Who?
Najarro. Uh, you remember Jose Najarro? I think he's been on one
Oh
time
yeah,
before. Yeah,
he
yeah.
works for the with contractors for the Molly Fool as well. At least
Yeah,
maybe in the past.
he asked Jensen Huang a question. But anyway, um, they are projecting that the company's AI chip revenue could reach $1 trillion by the end of 2027. Here's my take. That's not that crazy. With all the capex estimates, I that kind of makes sense.
Come
If the
on, Ryan.
capex estimates are real,
Okay, that's
why
fair.
would that not happen?
That's fair. Yeah, that's fair.
But
Um, yeah, that's crazy. It's crazy. I think it's crazy.
I mean, is it I feel like we've almost just become desensitized to
To the numbers,
putting
yeah, yeah,
putting numbers out there. $1 trillion in revenue is
it's a lot.
that is crazy. That is more revenue than any company in the world at this moment. I think the highest is currently Amazon in the
Is it?
700
Yeah, Amazon and
billions,
Walmart. Yeah, they're both at like 700.
and they're selling toilet paper, not high
They
productive
sell.
semiconductors.
Yeah, the yeah, I don't know. Yes, who knows? Who knows what it's gonna be? But what I thought was interesting was what the Dario, the founder of Anthropic, said on the what's his name? Dwarkesh podcast that all the tech people go on. He said, "Look, we're projecting at our current rate, our revenue is going from 1 billion last year, 10 billion this year, to $100 billion at the end of 2026. And if we're off a little bit versus what we have to spend to come in, the fact that we're growing so quickly could put us $200 billion in the hole if we're just off on what we're projecting. So that's why he's like, we got to act a little more cautiously on our spend where OpenAI is saying, well, let's just commit $1 trillion and see what happens. And it just puts
Yeah.
all those businesses. I think I actually have a hot take. I don't think the cloud is that good of a business. When's the cash flows showing up? Like it's actually I don't know if
Uh,
these businesses are that good.
I don't know. If if Amazon decided, let's not build a new data center.
Okay,
They
then you fall behind the 8 ball in 3 years.
but not on certain workloads, right? That's
Okay, yeah.
like
The IBM,
it
good
depends
for
on
you.
what you're like serving, right? Like storage, like AWS storage, I'm sure they're
Fair.
profitable there, you know.
Yeah.
But yeah, I mean it is fair. Like, is it just a spending treadmill?
Well, there's just an idea and kind of it's almost like a meme that cloud's one of the best businesses ever. And I was a before maybe looking at these businesses more closely, like 4 or 5 years ago, would say, yeah, you're probably right. AWS, wow, what a monster. But you kind of look under the hood and you go, it got so much upfront capital spending. There's better. I think there's better businesses out there. Um,
Like the stock exchanges, the
yeah. Last one. What about this? Thoughts on SpaceX forcing the Nasdaq and S&P to include them in the indices before the normal time frame and profit before the IPO. So
wait,
at
sorry,
the
repeat
IPO,
that.
you need to be included. And this is actually, I know we're going long, but on Blue Sky, the one person on there that I appreciate so far is Kabuki, who people have gone on fit Twitter. Goes, what is this guy talking about? Basically, one of the funniest people, ex investment banker. He's on there doing his whole thing. I missed him. It's been like 2 years and he's up to his old nonsense. But he wrote about this on his Substack, which is completely free. So essentially, uh, the basically the IPO when SpaceX goes public, they're forcing the Nasdaq to put them in the Nasdaq 100 before the actual time commitments of something like, oh, you got to be out for a year or what have you, or you have to be profitable. Isn't that just harassment? Am I wrong? Like Musk is shaking down the exchanges or the indices.
Yeah. Well, I don't know. The indices.
Good thing we just
Look at
own
the
10
latest companies they included.
yeah,
The Trade Desk, I think, is down 70% since they included it. Um,
Carvana.
Carvana. Who are the other ones? There's some other like just the timing is
Oh, oh,
always the worst.
yeah. Oh, Peloton. Yeah, there's plenty of examples.
I think that's gonna do it. Thank you,
Yep.
everyone in the chat. I see some questions around the Substack. The chat is totally free,
The
and
chat
there's
is
actually
free. Yep. Yep.
some great
But I have,
conversations going on there.
yeah. Then I have the premium research side of things, emerging modes, and it's slightly confusing under the same banner, but that is paid. But anyone can join the Substack chat. We talk all about the podcast in there. All right, Ryan, you gonna hit the disclosure or me?
Sure thing. Thank you, everyone, for tuning in. I want to remind listeners that Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Stocks is not formal advice or recommendation. We may buy, sell, or hold any of the securities discussed in this podcast. Thank you again for listening, and we will see you all next